which is seeing that along with realty. Realty, metal, PSU bank, auto, and IT are some of the key spaces where we are seeing pressure. Let's pull up the constituents of the Nifty IT. It's pretty much a secular red across the board. Even the breadth of the market is looking extremely weak. There you go. TCS down 3.5%. We're seeing almost a 4.5% cut on both Infi as well as Tech Mahindra. Coforge down nearly 5. L&T Tech and Mphasis. There's no end to some of this pain that we're seeing, not only in any specific sector, but across the market. I have with me Neeraj as well. Neeraj, do you expect this pain to just get worse from here, at least for today?
Anybody's guess, Harsh. I think that's the point that we've been trying to make since the morning, that let's not try and second guess what the extent of the damage could be, simply because at least I feel that I don't think it's possible for people to know the extent of the damage that could come in from a three-pronged concern that the markets have, right? One is, of course, the US data and the way it is. Two, as much as some of the guests today have said that the yen carry trade unraveling doesn't have as much of an impact, I think if you just look at the past instances when something like this has happened, the impact has been very severe. Sure, Indian markets may not be as badly impacted directly, but the contagion effect of what's happening in the world markets, and I think some of what's happening after the initial stability in the market today is by virtue of what's happening to the US futures. The Nasdaq futures are down, I believe, 3.5%. So there is consistent pain between Friday and Monday in the US markets. There is no surprise that we would fall, and no surprise that we should fall the way we will. Remember, as a market, we are stretched for valuations as well.
Yes.
So that's part one, that the yen carry trade unwind, if not directly, is having an indirect impact on our markets. This is, of course, the Dow futures, but if you look at the Nasdaq futures, those are the ones that are showing the serious pain that exists in that market as well, about 3% for the Nasdaq futures as well. So that's the first part of the equation. And we are maybe a tad bit better than what some of the other Asian markets have. Kospi triggered the lower circuit. Taiwan is down. China is a different kettle of fish because it hasn't corrected only as much, or hasn't gained as much. It can't correct. But I mean, look at those scenes out there in the Asian markets. There's no surprise that we are doing this, and no surprise that the volatility is gone up. By the way, Harsh, just one quick thing, and I know we'll get some phoners out there, but India VIX is doing today what US or CBOE VIX did the whole of last week. 40% uptick in CBOE VIX last week. So kind of we are showing the first signs of that. I don't think it's possible to say that this will end at a particular level or in a particular number of days. It's still unraveling.
So today's fall, Neeraj, and I'm just looking at the graphs. Today's fall virtually brings us to the level at which we were on the 1st of July. So the reversal isn't very, very sharp. Of course, given the kind of way in which we've gone up, but at the same time, there's plenty of pain, especially in the broader markets. Any specific sectors you are looking at in terms of which could play adversely given the current setup and given geopolitics as well, because exports could start to get impacted? That's something we haven't spoken enough about, if at all, given the entire Iran, Israel, US, the build-up that's happening there.
It's such a pertinent point, Harsh, but just that, thankfully, things haven't worsened as much out there. Imagine if you add that bit of element to this cocktail, and then how potent does that become? So that's the other piece to keep an eye out for as well. The thing, though, is this, Harsh, that anything which is export-oriented, as you said, comes under question. Metals probably come into question in a meaningful way. But I just think that a sell-off of this nature, essentially, everything will go down. I mean, sure, when the tide turns and some sectors will emerge stronger than others, but for now, difficult to say that. And which is why I think the point that you made about what will correct more is more important, because if you are from a trading mindset, then you want to keep a keen eye out for that, of not going long on those sectors. If you are a buy-the-dip trader, or if you are a positional trader, then maybe try and look at that. And therefore, certainly IT, chemicals are withstanding some pressure simply because the cycle is slightly different for them. But IT, metals, etc., certainly out there.
So couple of bright spots, if I can call it, in this market.
FMCG.
One is FMCG, of course. The entire rural play likely. And even at a point when valuations are elevated for FMCG stocks. But if you were to go out and buy something at this point, what would that be? We spoke about banks in the morning, or rather through the morning in India Market Open.
Buy cash, Harsh. No, the real point I'm making is that because you are not a mutual fund, you do not have those performance pressures. You do not have to make sure that you don't sit on cash or can't sit on 15% cash. What's wrong in sitting on 15% of cash? And the good idea might be that let the tide change. Now, you see the tide change. It's okay to buy 5% more expensive, but at least there is a bit of a certainty to this. What's the need? If you have been smart enough that at 25,000 or 24,800 or what have you, whatever the number is, you went out and you liquidated it because you heard the commentary that the valuations are expensive. Why be in a rush? Cash will be king in a market scenario like this because, like I said, I don't think anybody knows. We'll try and get the best opinion, but I'm guessing that the best opinion will give their hypothesis that we are a buyer at 24 or 23,500 or 23 as Mihir Vora did today. Because we believe from that level, we are looking at a 1 year, 2 year, 3 year view, and we are fine with taking that bit of pain. If you're a retail trader or an investor, you don't necessarily have performance pressures versus the index. You can sit on cash, you can make merry. Anybody who sat on cash from 25,000 levels is very happy right now. You don't be in a rush to deploy the cash, is all I'm saying. Just one last point, Harsh. The texture of the market today shows that it is not certain that this will change or stabilize after a particular level. Global markets are in a tizzy. There is this risk of geopolitics. No need to rush in.
Understood. One last point I want to try and get your view on, as well as probably throw some perspective on. You'll likely see at least there's talk of US recession. That's one thing to keep in mind. And therefore, you may want to tilt your portfolio in a certain direction. If at all I am to look at only a US recession standalone, along with possible rate cuts on the anvil, would you go slightly more positive on IT as a sector? Because that one's really beaten today. It's 4% down. Is this that opportunity to possibly look at IT?
Yeah, I mean, horses for courses, Harsh. I think Vinay Jaising today was making the point that while there is jobs peak index, which is higher, etc., and stuff like that, if indeed the US economy itself is going into a bit of a recessionary phase, and if decision making is going to be taken post the November election, which is now running close as well, again, no need to rush into that sector. Let the tidings turn a little bit. You missed the first part of the rally that the IT company showed post June 1st.
Yes.
Now wait for a bit and bide your time and bet into it. Again, because you're not a mutual fund, you don't necessarily have to get into IT, no benchmark pressures as well. But I mean, selectively, those businesses are great. And as and when the tide turns in the commentary or in the performance, sure. But today, I mean, you need a brave man to buy into this falling knife, which is Nifty IT, which is down 4.5 now as we speak. Quite a bit of shakeout there.
Yeah, absolutely. And mind you, the last time we saw this fall was immediately post-elections, which is first week of June. Now, just for perspective, the markets, of course, on that day were down, but post that, we've seen a very healthy recovery in markets. So, is this a possible, sell-off just before another rally? Is a question, Neeraj, which is going to confuse me, especially given the kind of move that we saw back in June. And we were talking about how it could lead to a larger sell-off, never came. We just rallied from there. We spoke about how flows have been extremely strong. None of those domestic factors have really changed.
Yeah, the only difference that if you identify the two falls that happened there versus what's happening right now, it's a global concerted fall that is happening right now versus what happened during the elections or otherwise, being a very local event, and the local factors didn't scare too many people and the flows were strong. It'll be very interesting to see the flows this week, by the way. So that's to be kept an eye out for, particularly from the domestic side. Is this the dip that domestic funds are buying? But Harsh, I'm just that in a matter of an hour and a half, from showing that sign of stability and being 1.5%, Sensex is now down 3%.
Yes, exactly. Did you expect that?
No, I mean, I'm saying I don't think anybody can expect anybody be surprised at anything.
Correct.
Simply because the extent of the impact that a yen carry trade unwind, coupled with softer data as well as geopolitics, is not known. It could be short-lived simply because the Fed action is round the corner. And from 2020, a Fed action has been the key trigger, key turning point, what have you. So that is round the corner, but that is only in September. We still have August to deal with.
And we have an RBI MPC as well at the end of this week. So it will be very interesting to watch out, or rather listen into that commentary.